Hello, and thank you for tuning in to episode 4 of our podcast series, Source of Truth, sponsored by our friends at Solo. Today's episode, the last episode in our series, is where we bring everything together, and the right guest to do that is Eric Woodward, former group president at Early Warning Services, and really an OG when it comes to questions around how to best structure data sharing infrastructure to make the financial services ecosystem work well. I mean, obviously, if you know anything about the history of the financial services industry, you'll know that EWS has had its fingerprints all over it. And Eric, playing a role on the fraud and risk side for decades at EWS, has a really good perspective on what it takes to bring different providers in the space together to share data for the benefit of consumers. And as you'll hear from our discussion, that's not an easy thing to do, right? There's a bunch of different models for how to do this. There's open banking, which Eric and I talk about. There's the credit bureaus, which Eric and I talk about. And there's consortiums, which obviously Eric knows extraordinarily well due to his time at EWS. And each of these different data sharing models has pros and cons. It has different advantages to consumers. It has different advantages to the participants in those various groups and to the users of the data generated by those different groups. And the question, which is a really fascinating policy discussion, technical discussion, is how do you design a system that benefits to varying degrees all of those different participants? How do you strike the right balance there? In this episode, Eric and we spent a little time talking about the practical realities of 1033 and open banking and some of the stuff that's happening. But for the most part, we dispensed with the practical for this conversation. And we focused instead on if you had a blank whiteboard and you could design a system to facilitate consumer permission data sharing for the benefits of everyone in the ecosystem, what would you design? What would the principles for that be? And what would be some of the most important considerations when bringing a system like that to life? As you'll hear from our discussion, there's a lot of nuance to that idea. There's a lot of considerations that we're probably as an industry going to need to argue about maybe for quite a while. But as you'll also hear, I think Eric and I are both relatively optimistic that we might see progress in this area sooner than you otherwise might think. So without any more ado, I am delighted to bring you episode 4, the last episode in our series Source of Truth, featuring the one and only Eric Woodward. Eric, thank you for joining me.
Hey, Alex, great to see you today.
It's great to see you too. We are recording our final episode in this series, and much like in a relay race, Eric, you're our anchor. You're going to bring us home. So really appreciate you being on, and genuinely really excited for this conversation. You and I think, know each other via the internet and email, but I don't think we've ever actually done a podcast together. So I'm really excited for this. I know your background and the stuff that you've worked on in the past, but to set context for the audience, would you mind giving a quick introduction to yourself and your prior professional experience?
Yeah, sure. So I spent the better part of the last 2 decades helping the largest banks in the United States build a fraud risk consortium known as Early Warning. And the purpose of Early Warning was really a way for banks to share data, financial data on consumers, to give good consumers better experiences, to get them into the right accounts for their financial needs at the time. A lot of the product and solution was around, are you really who you say you are? Are these your bank accounts? Are they affiliated with you? Are they open and active? As well as understanding devices, so people, accounts, transactions, and devices. And I spent a lot of time helping the banks get that built and set up. And so Early Warning is the parent company of Zelle. And I helped build all of Zelle's risk services and was president of the company, overseeing the risk solutions business. Since then, I've spent the last 5 years now advising the leading companies in the space focused on fraud, risk, identity, and payments. and helping the largest banks, but also now fintechs and other tech players who all are confronted with similar challenges in terms of understanding their consumers and associating their bank accounts with them.
Great. Okay. So that is a really, really good introduction for obviously great background, but also for this discussion, because you're the perfect person to ask some questions to that I've been wondering about. As you outlined, the thing that I think is really interesting about your experience and a good parallel to the issues we're working on today is you have to have good data underlying any transaction that you're going to have, right? I mean, I like the way you described Zelle as being kind of the outgrowth of all the work that EWS had done for decades on risk and fraud, because if you don't know who the parties are in a network, you can't lend money, you can't do payments, you can't do any number of other things, right? So we're obviously in this series talking a lot about the infrastructure that underlies a lot of those decisions and transactions. And a question I want to ask you, which I've asked many other folks in the ecosystem, is your take on the JP Morgan Chase news. Obviously, one of the biggest things that's been happening in the industry, as listeners know, Chase took the very aggressive step of introducing pricing for its open banking APIs. And given your experience working with the largest banks on data and risk and creating kind of common infrastructure, I'd love to get your take on just what you thought of the news and what you think it kind of means for the ecosystem.
Yeah, I mean, look, this is one I'm really torn on, both personally and professionally. I do sit on the board of Trustly, who's one of the open banking solution providers that was ultimately impacted by this. So, I'm going to take that board hat off and speak as a consumer and speak as an industry professional. I do understand Chase's perspective. It does cost them a significant amount of money to manage that data, to protect that data, secure that data. And, from the beginning, they've always put out rights for access for online, which is do not share your credentials with third parties. And that, consumers basically ignore those rights because they want to have, ease of use of their data set. So while I agree that it is ultimately the consumer's data, we effectively pay and hire the banks to be stewards of that data and to keep it secure. And of course, if there is a data breach, the first thing we do is demand some sort of compensation for that. So it's a difficult situation. I think that when Chase came out a week or 2 weeks later and started sharing some of the data points on who's hitting their servers, when they're hitting their servers, how frequently they're hitting their servers, it painted a little more clarity. If I were their comms person, I might have suggested they do that at the same time to just explain the situation. But it's not surprising. Probably the only thing that's surprising to me is that so far it's still only been Chase and that others haven't followed. I guess less surprising is the fact that the current administration now is jumping into the fray and will have an opinion on it. We'll see which way that ultimately shakes out. But no, I think that under the former CFPB and 1033, the idea of consumer access to their financial data makes perfect sense. And that should be a right, given that you're sharing this data over with banks. At the same time, free access, I don't know that that's necessarily how it would need to work. Imagine in the old days, if you'd walked up and said, I need an extra statement printed. I mean, For sure, banks used to charge for that. And it might have been de minimis, but if you said, I need 5 years of all of my financial statements printed and they come out with 300-page book of data, you wouldn't necessarily think that should be free.
Sure.
So look, I think what we need is access to that data to build better products and services. Consumers, especially today's younger consumers, are expecting things to be in real time. You can't wait until the month's end to get a statement cut into a PDF that you can download and then upload. That's not how today's internet works. Even with AI, you wouldn't want that to be how things work. So I think that there's a middle ground here. If nothing else, I think what Chase did gets the sides talking. I can imagine that they probably had suggested this in the past, weren't getting heard, if you will. And this assured that people would be at the table.
No, that's 100% true. And, we are obviously in the very early stages with the CFPB kind of reversing course and deciding to wade into the middle of this. And, on the practical considerations around this, like we'll see what happens, right? 1033 is silent on the issue of fees. So it really is something that's up to regulators to decide with industry. But I want to leave in some senses like the practical realities of what can or can't be done under 1033 behind a little bit and talk more about theoretically what's the best way for an ecosystem like this to work, right? Because we can get kind of hung up in the legal wrangling over what's in the statute and what regulators are allowed to do under Loper Bright and blah 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 blah. But I think a much more useful policy discussion is how does this work in a sort of normative fashion if we're trying to design it best for the ecosystem. And I also think it's worth pointing out that this is not the only area where this tension exists, right? The other example that I always think about, and this relates to my personal experience working at FICO and kind of working in that area for a long time, is the credit bureaus, right? And obviously, the credit bureaus are a different form of data sharing infrastructure. They were founded, hundreds of years ago. Like, I mean, literally, like the oldest ones are over a century old. They sort of digitized their product in like the late 70s, early 80s. Obviously, the FICO score came along in 1989. So over the last 30, 40, 50 years, they've sort of developed a parallel infrastructure to a lot of this. And, I think it's really telling that a lot of new lenders, and we'll just use like buy now, pay later as the example, they're growing to the point where, arguably you could say, yeah, hey, maybe you should furnish your data to the credit bureaus. And for the most part, with a couple of exceptions, the buy now, pay later, pay in four providers have not furnished data to the credit bureaus. They give a certain set of reasons for doing that, which are technical in nature, or we don't know what the impact on our end customers is going to be. But I also think there's a very reasonable objection that they would have as a company operating in 2025, which is like, why are we giving our data away for free to the credit bureaus? Like, I know banks signed up for this deal in the 70s when they might not have understood the value of the data they were furnishing for free. But like, we understand the value of our data and we think it gives us maybe a bit of a competitive advantage. And like, why are we signing up for this deal? And so I'd be curious to get your take on that side too, because in some ways, if you step back, that seems like another example of the same objection that you're seeing from banks where it's like, okay, why are we doing this without in any way being compensated or getting value back?
Yeah, I remember talking to a few people, a few of the executives at the bureau, saying they've got the best business model known to mankind, free cost of goods sold,
Totally.
right, and 100% margin.
Hmm.
At the same time, obviously, they do provide a value back, and you can't get that value without having some form of data sharing requirements. Honestly, it's why the banks built early warning to have their own version of a bureau that they could share data internally and have 100% ownership of. So, ultimately control the economics and what they look like. It's the same reason why early warning launched Zelle for the banks, is that, again, rather than trying to cut some partnership with Apple, we've seen how that worked out, or using technology at Venmo or PayPal and connecting up to that, they wanted to have control of what those costs ultimately looked like. So for sure, you're going to see buy now, pay later, and any other solution providers that would benefit from being able to share their data think long and hard about what will they get out of this. But I think ultimately the value of sharing those insights to have a better perspective on the consumers that are in front of them, and especially if you're thinking about buy now, pay later, where the consumers tend to be underbanked at a minimum,
Hmm.
right? And of course, it's crossing over more and more into mainstream. But interestingly, paying for mainstream, you're probably using your Amex card or your Chase
Right.
card, and so it's a different type of customer. But for a lot of the BNPL players, they're just not going to have a rich data set on that consumer. So the more data and insights that they can get access to, the better that they can offer services. And if they think about themselves as second chance companies, then of course you want to be able to give anyone and everyone that you can that second chance or third chance, fourth chance. And you have to, you need additional data sets to be able to do that. So whether it's sitting at the bureau or somewhere else, there's a need to have that happen. So I think the real question is, what's the construct to enable that to happen?
Well, that's exactly what I want to talk about, right? Because one of the things you're sort of putting your finger on is this natural tension between data sharing and data sort of retention, right? And I guess the way I would kind of frame it back to you, and I'd love to get your quick take on this before we dig into like what a better version of this might look like, is, on the one hand, you can absolutely understand the very narrow view, which is like we have first party data that is proprietary and that we can use to make decisions. And it gives us a huge competitive advantage if we're the only ones who have this data. That's like kind of one level. The second level is, okay, we like having our proprietary data, but there are certain problems that exist at an ecosystem level that if we don't share some data as an ecosystem, we're going to have a problem. And you sat right at the center of this, right? Because this is fraud is a perfect example of this. And I actually think that like EWS is a good example. Buy now, pay later, we might see the same thing, right? I've heard discussions that are happening very early, but maybe the BNPL companies will create their own little fraud data consortium for BNPL users who stack loans and kind of play the different BNPL providers off against each other, right? Like that would be a very narrow, tailored approach to sharing data that would allow those BNPL companies to coordinate or to work together in order to address a very specific sort of non-competitive issue. And fraud is nice that way because fraudsters are the enemy of everyone. So you can sort of forge consensus around that, while at the same time keeping it narrow to BNPL, not sort of going beyond the bounds of that. The third level, and this is where it starts to get a little tricky because you have to think more about what's beneficial to your consumer versus to you, which is an interesting sort of jump that institutions need to make, is if I'm using BNPL and say I am like an underbanked or unbanked or kind of credit invisible consumer, and I'm using BNPL and it's kind of my on-ramp into payments and lending, well, eventually I'm going to need an auto loan. I'm going to need a mortgage. I'm going to need maybe a loan to start a small business. I'm going to need products that, at least in the short to medium term, buy now, pay later providers do not provide, right? And so there is a benefit to the consumer in having their data shared or be able to be shared more broadly so that other lenders can also work with them, right? And so if I think about the sort of costs and benefits of data sharing, it sort of strikes me that there are these multiple levels. And I'd be curious to get your take on that from your experience working at EWS. Like, how do banks or just other incumbents think about those different levels from this is our data, it's proprietary, to we want to coordinate, but in a focused way, to, okay, we're open to sharing more broadly in order to make the ecosystem work well for consumers?
Yeah, look, at early warning, we had a saying, we were permitted and allowed to make the reds redder, but you couldn't make the greens greener. So you could say someone was green, but you didn't know if it was a minnow or a whale. Or maybe we knew, right? Maybe we had enough data points to have seen, and even some of the richer data sets of how many accounts, are you at, is it a Bank of America account or is it a Bank of America Merrill Lynch account, right? A U.S. Trust account, right? And having different perspectives. And have they had it for 2 years or 10 years? Did they grow from B of A to U.S. Trust to Merrill Lynch, right? And you can sort of see progressions. Have they had any sort of bounce checks? So once you have that rich data set, of course, you'd be able to underwrite extremely well off of it. Yeah. And I think the challenge is if you had an early warning enhanced FICO score, it would test off the charts. And of course, you see that with open banking, all of the different cash flow based underwriting solution sets and the value of them. The problem is that consumers are obviously only going to bring their best accounts to connect up. And so it's an inflated score at best because you don't get to actually see the whole picture. So if you have a consortium where everything's contributed, you get a true 360-degree view. But then the age-old question of, did I just use Bank of America's data to help Wells Fargo pick off a Bank of America customer? Obviously, less than ideal for members of the consortium. And so, where does that friction versus value tend to lie? My perspective, I think that it ultimately sits to the consumer. Now, of course, the companies I worked for, it's not that they didn't have the consumer's best interest in mind, but they certainly were driven by their bottom line, not the consumer's bottom line. And the technology historically hadn't existed. Of course, you have things like self-sovereign identity and wallets that you could sort of cobble together all of your data into, but you couldn't just then show up at a Bank of America or a Chime and say, plug into this, and here's all of my data. And even if you could, like, let's just say the simplistic version is Dropbox, or a place that you stored all of your financial data, and then you just upload it as you're applying for that mortgage. They still have to then go out and verify each piece of that data, where, because it's just a PDF to them, right? So where did it come from? Does it look like a Bank of America statement? Do we have verification? What are the third party? So much effort around it. And so ultimately, I think it's some combination of the consumer having control, consumer permissioning, open banking, access to the data sets, verification on top of it. But these are all a number of manual processes that need to be automated that today around data have not yet caught up to where we are, for example, on the payment side.
No, I think that's right. And just to kind of put a fine point on that, the thing that is really interesting that you're kind of talking about is these different worlds kind of colliding with each other, right? And so, one model of how the world has worked historically is the credit bureau model, right? And the credit bureau model, the thing that's nice about it, to your point, is that it does facilitate competition for consumers, right? In a way that like a consortium model probably is a little more reluctant to, obviously, because like all the consortium owners are not going to agree to let their data be used to pick off their customers. The credit bureaus, just by virtue of this being this historical artifact that existed since the 70s, they sort of play that role in the ecosystem where, no, like, you're furnishing data on making greens greener, and that should allow someone who's sufficiently sophisticated to go, you know what, you're not getting a good price. I can pick you off and take you. And so like that benefits consumers, but is challenging to stand up in other ways. So there's kind of your credit bureau model. The credit bureau model also is consumer permissioned, but really in like the lightest possible way, right? Like, yes, you are checking a box allowing someone to access your data. You don't have any control over the data being furnished. And I've written about this, your ability to like dispute things or to freeze your file or whatever, like try going through that experience a few times. I recently tried to freeze my kids' credit files, and it's an insanely complicated and not good process, right? So it's really not very consumer friendly. And then to your point, and this speaks to the BNPL thing, the credit bureau model just really isn't going to be appealing to someone who thinks about the value of their data in a modern context, right? Like, this is my data. Why am I sharing it for free? And so you have that model. That's one way of thinking about this. A different model is the consortium model, as we've been talking about. And the consortium model, similar, I guess, in some senses to the credit bureau model, where it's benefiting consumers, but it's not something that's really built on consumer permissioning. It's, institutions sharing data amongst themselves with sort of limited visibility for consumers. It does really solve the problem of coordination and cooperation between the providers, right? Because it's limiting the economic impact or the competitive impact. It's allowing them to just make the ecosystem work better. As you said, it provides a much richer 360-degree view of the data. The other thing you kind of hinted at that I just want to point out explicitly is that consortium model also comes with a really rich validation from the contributing providers, right? Like, they can tell you it's not just a PDF you're seeing. Like, this is, we vetted this, here's what we looked at. You can understand how we evaluate this risk. Like, the data has like lineage built into it that's really strong and powerful in order to make decisions off of. So you have the consortium model. And then the third model, as we've been talking about, is the open banking model. And to me, that one is really, really good on consumer permission. It's granular. The consumer can bring exactly what they want. They can revoke permission at any time. Like, it is really built around consumer permission in a way that other models aren't. But as we've seen with Chase and with other examples, it doesn't necessarily solve some of these concerns that providers have around getting compensated for the data or them getting value out of it. And then, as you indicated before, a lot of it is like data without a lot of lineage attached to it, right? Like I might know this comes from Bank of America. That might come with certain things I can assume, but you're not maybe getting as much rich insight into the source of the data, what it means, how the providing institution thinks about it, the verification that went into it. Like it's kind of a black box. And the example I would sort of give you there is, you know, a bank account from, I'll just pick on them because, you know, they were right at the center of all the banking as a service stuff, but like bank account information from Evolve should be treated very differently from a trust perspective than bank account information from Bank of America, right? Like those two should not be considered equal. But from a data aggregator's perspective in an open banking context, you have no ability really to assess the difference between the two. So if we think about those as kind of three different models that all have pros and cons, I would love it if you could talk kind of theoretically about how a different framework, if you were to just draw it on a whiteboard, how it might work or what some of the considerations would be that you would bring to a new model. And obviously, this is us operating in kind of imagination land a little bit, like we're sort of setting aside practical constraints for a second. But like if you could draw it up, what would you try to design to solve for some of these issues?
Yeah, it's interesting because obviously you need to solve for the consumer's financial needs first and
Yeah.
foremost. Otherwise, why would they participate or allow their data to be used and leveraged? At the same time, it has to be beneficial to the furnishers of the data. Those could be financial institutions, but it could be other third parties, right? I mean, presumably knowing whether or not you've had the same cell phone number with a telco for 3 months or 3 years has some rich value to it. And just similarly, as you compare Evolve to Bank of America, it's the same idea. Is this Mint Mobile on a prepaid account or is it Verizon on a postpaid account? Right. And again, rich data points to understand in context. I think so. First and foremost, consumers should be at the center. Secondly, don't limit furnishers to just large financial institutions who happen to have spent a lot of money to enable open banking access, right? So it should be all sorts of financial data and even things that may seem like non-financial data, but like telco data, utility data, but actual have strong implications as to maybe everything from your ability to pay to your intent to pay. So I think that those should be a part of it. I think there's a way to enable value back to the furnishers. I think back to when Zelle was first launched, and it was always intended to be free. So I won't name names, but it is public, so you can find it. One of the first banks that launched it decided that they would charge for it. So it was $6.95 to do a Zelle transaction, but it was instant.
Sure.
And of course, that fell very flat. I think they did maybe 7 transactions, so it's something. but what's interesting is that concept actually ended up taking off with other providers. So now you can pay to get instant money with Venmo and Cash App and PayPal. But the difference is instead of charging everyone a flat fee, they decided to let the consumers choose. So if Friday night and grandma sent you $100 and you're in college, and you can either wait until Monday to get that money and go out, or you can get it $98 tonight and be able to go have some beer and pizza with your buddies. You just think grandma sent you $98. So you don't mind paying ish, right? You don't even think of it that way. And so I think that that's the key, is that setting this up so that there's an ability at the right time with the consumer's consent for furnishers to get paid or for third parties to pay for access to that, where again, maybe both furnishers and consumers could benefit in it. I think that those would be constructs I'd look to have enabled. Of course, you want to avoid any of this where it's only best picture. So how do you not just incent, but effectively require that contributors contribute all accounts, right? So not just the good accounts that consumers may choose to share. It's kind of like looking at a resume, and when you see over a 5-year period 2 1-year gaps, with no mention of what happened,
Yep.
you kind of know what
Right.
happened, right?
Right.
And so same idea. I think there's got to be some sort of inclusivity, but ultimately, all of that just begs to have some sort of rules.
Mm.
Now, I don't think it requires the 300 pages of operating rules that some consortium players in the space have, but I think that network rules exist for a reason, and you can see the success of Visa and Mastercard with the rule set that they have because everyone understands what they are when you join the network, and then everything is normalized and standardized, so you know what is required for you to give in and what you'll ultimately get out on the other side. So you can build your systems on top of that to create value. So I think having that set of standards, some form of operating rules, I don't know that it needs to be bank governed or even furnisher governed. But I think that with today's technology, you could effectively wrapper rules down to the individual furnisher level. So Chase may be comfortable sharing data with the consumer's permission for 90% of use cases, but they may just never be comfortable for certain use cases. Even though it's the consumer's data, they feel culpability being a part of the transaction. So could you, using some form of smart contracts, doesn't necessarily mean blockchain, some form of and effectively wrap a rule that says, hey, if it's Chase, you can't use it for XYZ solution industry company. I think all of that's possible. It will require technology being put together today, and effectively, what you're trying to do is automate what is otherwise an existing manual process. You've seen, like if we look at the mortgage space, you see companies like Blend that did a great job of creating a much better experience, but the way they did it, selling effectively software to financial institutions as opposed to creating a standardization for the industry, left a lot to be desired. And so I think that ultimately bringing something back to the center is really the right solution.
Yeah, I totally agree. And you touched on a bunch of interesting concepts there, right? I like the principles you outlined in terms of, we need to see the entirety of the consumer, right? And I candidly, I think that's one of the areas in open banking that we haven't really fully seen the dark side of yet. But as it becomes a bigger and bigger deal, like we take for granted the fact that we have credit files or, consortiums like EWS that furnish the entirety of the data on what's happened. And it is to the benefit of the ecosystem working efficiently to see everything that's happened. Because as you illustrated with the resume example, there actually might be a reasonably innocent explanation for the gap on your resume. But if you leave it as a gap and you don't explain what it is, the employer who's thinking about hiring you, I'm just going to assume the worst. Like I'm like, in my brain, I'm jumping right to prison, right? Like, and I probably shouldn't, but I am, because like blank spot is very scary to someone who's making a risk decision, right? So I think that's a really, really powerful one. I also think, obviously putting the consumer at the center and more granular consumer permission is really, really important. It's always struck me that like, if the credit bureaus worked the way they did, but with just greater and more granular consumer permission built on modern technology, not 1970s technology, we would actually have something kind of close to what we're talking about here. So I think that's really powerful. And then just to double click into one of the ones you mentioned that I want to dig into a little bit more, this idea that consumers and others would be willing to pay based on value, I think is really, really important, right? And obviously, like the difference between Zelle and a Venmo in terms of like how fast the money moves and if you're willing to pay for that or not, I think that's a really great case study, actually, right? Because obviously banks were trying to sort of catch up to the fintech companies, and so there was an incentive to make it free. But in general, I think consumers are willing to pay for value. I think that providers are also willing to pay for value. And mortgage, to your point, is a really great example of that. I mean, a company that, or a division of a company that doesn't get talked about a lot in these discussions, but should, is the Work Number, right, that Equifax owns. And they sell verified employment information to lenders and to others who need that insight. What's interesting is the price they charge for mortgage versus the price they charge for personal lending wildly different, right? One is like 30 cents and one is like $300, right? And that might be a little bit too wide of a range reflecting their market power. But I think it also speaks to the fact that different use cases for data have different value, right? And, just to give like one example, the cash flow underwriting one is really interesting because I, I don't think it makes sense to just say no. We should get every piece of data that we need to make a credit decision to lend money for a mortgage or for an auto loan or something. We should get all of that data with the cost of it being zero, right? Like that doesn't really make sense. That's probably not fair, and it probably also underplays the value that the data providers in that model can bring to that beyond just raw transaction data, right? So, like, if a question I ask myself sometimes is if banks had leaned into open banking years ago and had looked at something like cash flow underwriting, what is the API, the premium API that they could design for lenders that would give them a much richer view of the data, the lineage of the data, all the different pieces that they need, attributes? Like, there's a premium version of cash flow underwriting that data providers could cooperate to create that I think consumers and or lenders would be more than willing to pay money for and could be a revenue line. So I think that in particular is an area where when you look at open banking, and sometimes when we talk about these things as like the language of consumer rights, we sort of lose track of this a little bit. But like it seems like there's a pretty big economic opportunity there that people would be willing to pay for. Do you think that's fair?
Absolutely fair. In fact, not well known fact. We had agreement to acquire one of the OGs in open banking back in 2014
Oh yeah.
before they went
Yeah.
public, to bring it under the auspices of bank control
Hmm.
and bank solutions. And had that happened, of course, the Plaid wouldn't exist and Akoya wouldn't exist. You wouldn't need them
Right.
because the idea was, how do you get access to real time data? How do you enable it with the right controls in place for the consumers? And it would have been this, kind of quasi blend of open banking plus bank contributed data, so
Yeah.
that again, when I, as a consumer, just show up with my good account, I still have a fail-safe mechanism that allows the consortium viewpoint that says, what about the Chase account
Right.
or the Chime account? How do you connect those as well?
Hmm.
And so, and there are reasons why it ultimately didn't happen, but for sure, there is a need to have that type of a solution in place, with a governor, ultimately, some sort of, again, solution to just tell you, hey, there's a few other accounts you need to ask about or that have to be contributed. But yeah, I think that consumers will pay for the right thing, the right solution. I think that providers, we already see them pay, significantly. And what's interesting is that because they pay today, there's a chance to actually give them a better experience at a cheaper price for a higher quality solution than what they actually get today. So that's where the internet shines, right? And certainly, I think with AI being able to build new solution sets that are out there pulling this disparate data together in real time is going to be really exciting to watch this unfold. And I can't imagine that the bureaus of today last another 100 years.
It seems unlikely just with the model and some of the problems we've been identifying with it. I mean, I feel like there are too many cracks in a lot of this stuff. And, FCRA is a really old law that I have begged for years to like, please Congress modernize this law and like take a new look at this. Cause I think you're right. I think a lot of this needs to be refreshed. And, just one more point on the consortium one that I'd love your quick reaction to. I think your point earlier about network rules and how these things are governed really does matter, right? Because the incentive on the part of a consortium, if you just leave it to its own devices entirely, is going to be to preference the benefits to members and owners of the consortium, right? And so this is why a lot of things with bank-owned consortiums don't include fintech companies, right? Because they're not banks. They're not part of our group. They're over there. It is to the benefit of the ecosystem and the consumer if those other entities are included, but left to your own devices, you might not decide to do that. I also think that, so from a regulatory perspective, maybe we have some overarching view of this where it's like, yes, we want this to be a consortium. We want there to be data sharing. We want there to be shared economic benefits. But we also want the consortium to be open to anyone who meets these basic criteria that maybe sit beyond that perimeter. The other part, and I think this is really important because it's been kind of a weakness, honestly, with open banking, the role of like the notches of the world or the standard setting organizations, Visa and MasterCard for that matter, like those really, really matter in this because you don't want regulators involved at that level. That like never works well. It doesn't go well. But you also, again, don't want to limit it to a very small number of providers that can preference their benefits to their organization over others. And so I think like the role of independent standard setting organizations, not just to create technical standards, which is kind of what we've had to date in open banking, but like network rules, like who is going to get to do what under what circumstances. I think that's the other part that's really important here. And from a regulatory perspective, I really hope that regulators can push more of that responsibility down to those standard setting organizations, because it feels like that's the only model to like work out some of those difficult questions.
Yeah, I like how you're thinking about it, because clearly you see when the providers themselves write rules, how restrictive it becomes, and the idea that banks won't share data with fintechs because they're worried the fintechs are more primed to steal their customers. Well, of course, they were built from the ground up.
Totally.
Today with real-time solution sets to appeal to the consumer who wants instant access to cash and services. A better solution is, how do we compete with them? How do you acquire them so that you yourself can offer the consumer the same? Not how do I block them for as long as humanly possible to keep running my revenues?
Right.
So, sometimes it requires regulation or regulators to step in and enforce some of that. Sometimes it requires the industry coming together and creating standards bodies. And we've seen all kinds of standards. I mean, Wi-Fi is a standard that ultimately get different participants to come in, chime in, and then kind of keep iterating on it. So I think that data, we're clearly not there yet. It's going to be really interesting to kind of see what the new perspective is of this administration. And they've shown a desire to obviously do things very quickly and decisively. And I'd say fairly aggressively right now. Of course, whether you're on the right side of that aggression or the wrong side, it all depends. But certainly, they've been leaning in heavily into the latest technologies and things like the Genius Act and stablecoins and kind of all the implications of that. So, could you see a Genius Act for data? I wouldn't surprise me. Some sort of something similar, and then does it require standards bodies to ultimately interpret that and apply it to the industry? Probably a good outcome.
Yeah. A Genius Act in terms of the urgency and the focus and the speed for consumer data that goes beyond what we've been kind of tussling with 1033 and these very like vague statutes that we can't really seem to ever agree on an interpretation for. I think that is a wonderful thing to wish for. And also, honestly, not something that's completely out of bounds that we might see in the relatively near future as a lot of these issues kind of come to a head. So, Eric, I think that's a great place to leave it. Thank you so much for coming on. Thank you for persisting through some technical difficulties we had to start the podcast. I really enjoyed this conversation.
Yeah, Alex, thanks for having me. I really enjoyed it. Was looking forward to this for a long time. So glad we finally got a chance to connect and appreciate being invited to your podcast.
Well, thank you for coming on.